So, ladies and gentlemen, good morning, everybody. I'd like to invite you and welcome to the regular quarterly meeting of the Czech National Bank with analysts. The Czech National Bank today will represent Mr. Governor Miroslav Singer and other experts on his left. But first, we'll start with presentation of Mr. Hledík, who is ready. But first, let me tell you some technical points. It's really necessary. I would like to ask you to switch your mobile off or use regime air regime or plane. I don't know if it's correct, because to have our webcast broadcasting good quality and reliable for our auditors outside. Thank you very much. Mr. Hledík, over to you.
Good morning, ladies and gentlemen. I would like to welcome you at the Czech National Bank, and also I would like to welcome those of you who are online. It's my pleasure to present the Czech National Bank's new forecast, and let me start with the outline. First, I will introduce the assumptions of the forecast, then I will talk about the inflation forecast and the overall macroeconomic development. Then I will touch upon the comparison with the previous forecast, what we produced in the summer. And since it's exactly 1 year anniversary when the Czech National Bank started to use the exchange rate as instrument, I will just assess what we experienced during the last year. So let me start with the assumptions of the forecast, and namely the external environment outlook. As you can see from the graph, the GDP growth in the effective euro area slowed down in the second quarter. The main reason for that is just a slowdown of economic growth in Germany. And you see that the more significant pickup is expected in the second quarter of 2015. The anti-inflationary environment is also visible in terms of producer prices. The fall in PPI is quite deep and long-lasting, and it reflects the weak economic growth in the euro area and also very low commodity prices. The recent step of the ECB to ease monetary policy is showing up in the development of the 3 months euro Euribor rate, and it is expected to be low over the whole forecast horizon. The euro will continue to depreciate against the US dollar, and besides the accommodative monetary policy in the Eurozone, it's also given by the decision of the Federal Reserve just to discontinue with its quantitative easing policy. In terms of domestic development, the forecast expects for 2014 a slight increase of the deficit, public deficit, to 1.4% of GDP. This is mainly given by the revival of public investment and also increased current spending. And against this, the budget will be supported by higher tax income coming from higher economic growth, and also extraordinary revenues coming from the auction of frequency bands to mobile operators. In 2015, the forecast assumes the increase of the deficit to 2% of GDP, and there are a number of expenditure items that will contribute to this. Let me mention the abolition of most fees in the healthcare, an introduction of a new 10% reduced VAT rate. The government is planning to increase pensions and also public wages, and we also assume a accumulation of public investment financed by both EU funds and domestic sources. There is one more, maybe a little bit more accounting effect, and this is the extension of the lease of the US Gripen supersonic fighter aircraft, and this will have just a one-time effect without any effect on GDP. In 2016, we assume decline of the deficit to 1.5%, and actually that will be a result of continuing economic growth. In terms of fiscal impulse, in 2014, we assume we estimate it's 0.3 percentage point, and it will slightly go up in 2015 to 0.5 percentage points. And we assume a slightly negative fiscal impulse in 2016, and actually this is given by a drop in public investment. In terms of monetary policy, the forecast expects market interest rates to be flat at their current very low level, and the current exchange rate to be used as an instrument for easing monetary policy until the first quarter of 2016. Market interest rates are forecasted to increase by around 0.8 percentage point in the second quarter of 2016 and rise further afterwards. The forecast expects the exchange rate of the krona against the euro will remain close to the level of 27.4 Czech crowns for the euro for the next few quarters, and this is somewhat weaker level than the announced asymmetric exchange rate commitment. As you know, it's 27 Czech crowns to the euro. As we communicated several times before, we expect that the return to conventional monetary policy will not imply an appreciation of the exchange rate to the level recorded before the Czech National Bank started to intervening, as the weaker krona already, we believe, transmitted into prices, and this will continue on the forecast horizon as well. Okay, let me turn to the description of the new forecast. And first, I would just provide you a brief summary. Both headline and monetary policy relevant inflation remained in the third quarter of 2014 below the lower boundary of the tolerance band, and they will continue to increase towards the Czech National Bank's 2% target, and at the end of the monetary policy horizon, they will exceed it. The inflationary effect of import prices will turn to anti-inflationary at the beginning of 2015, and practically the main reason behind it is just the fall of producer prices, which are transmitting into import prices with some delay. At the same time, we assume that the exchange rate will be stable. In contrast to the anti-inflationary effect of import prices, the domestic economy will start to generating inflationary pressures due to continuing economic growth and accelerating nominal wage growth in the business sector. Following its decline in the last year, we expect that the GDP growth will reach 2.5% this year. The same growth rate is expected for the next year. In terms of the main factors, we assume an improving external demand. We believe relaxed domestic monetary conditions will contribute to growth and also increase government investment. The growth rate will slightly increase in 2016 despite the fall in government investment. The economic recovery is already manifesting itself on the labor market through the renewed growth in number of employees converted into full-time equivalents. And we expect that this will continue also on the forecast horizon as the economy is growing, and actually in 2016 it will accelerate. The unemployment rate will decrease gradually. The wage growth will noticeably increase in the business sector, and the same holds in the near term for the public sector wages. Okay, I can start to discuss the inflation forecast, and you can see from the graph that the headline inflation remained in the third quarter of this year below the lower boundary of the tolerance band around the target. At the same time, we were able to move from the almost zero level in the second quarter, and the forecast expects that this will continue towards the inflation will continue to increase towards the Czech National Bank's target, and at the end of the monetary policy horizon, it will slightly exceed it. In terms of the structure of inflation, the year-on-year decline in administrative prices in the third quarter was more than offset by the increase in food prices and adjusted inflation excluding fuels. This you can see on the left-hand side graph. And you also can see, or you cannot see because the gray bars are practically zero, that the change in fuel prices practically not contributed to inflation at all. And if you look on the right-hand side graph, you can see that adjusted inflation, excluding fuels, remained positive in the third quarter, and actually it was supported by both components. And if you have a look, then good news is that the prices of non-tradable goods are growing and steadily growing, which is, in a sense, an indication that the domestic economy is already able to generate inflationary pressures. It is not too much surprising that the prices of tradables are growing after the weakening of the Czech crown. Okay, in terms of monetary policy relevant inflation, it will increase close to the inflation target. Practically, it's the same story as for CPI. The only difference is the effect of indirect taxes, where for this year we assume that the increase in excise duties on cigarettes will have a positive contribution to inflation. And for the next year, the introduction of the second reduced VAT rate at 10% will slightly influence inflation, but this, as you can see, this is really a marginal effect. In terms of the structure of inflation, net inflation reached 1% in the third quarter of this year, and you can see that we expect a slowdown in the beginning of the year, next year, due to fall in food prices and fuel prices. But the forecast expects that net inflation start to increasing after that and will reach 2% at the end of 2015 and remain above this level in 2016. Administrative prices will decrease by 0.2% in 2015. The main reason behind it, just lower energy prices and the abolition of most co-payments in healthcare, and we assume more or less just steady state growth in 2016. In terms of market inflation structure, you can see that core inflation will speed up during 2015 in an environment of pronounced economic recovery, and actually this will be accompanied by a gradual revival of the labor market. Food prices are expected to decrease, but only temporarily at the beginning of 2015, and this is given by the fall of agricultural prices. And later on, as you can see from the forecast, the food price inflation will pick up and will reach 3% in the end of 2016. If we have a look on a more structural way of what are the factors behind the inflation development, then, and we have a look on the nominal marginal costs in the consumption sector, then you can see that domestic inflationary pressures will continue to build up in the coming quarters. Already, these yellow bars, which are capturing domestic prices, are positive from the second quarter of 2014, and you can see that on the forecast horizon they will add more and more to inflation. At the same time, the graph is showing that the import prices were generating marked inflationary effects at the beginning of 2014. Of course, the main reason is just weakening of the exchange rate. But at the same time, it's clear that from the beginning of 2015, import prices will switch to an anti-inflationary mode, and the main reason behind it, as I mentioned previously, is a fall in foreign PPI prices and a stable exchange rate. Increasing wages and cost of capital will be driving the growth of marginal costs in the intermediate sector, and this will be partly offset by curbing effects coming from productivity gains. Okay, in terms of the real economy, the forecast expects that the GDP growth will reach 2.5% both in 2014 and 15, and we expect a slight acceleration in 2016. and the economic growth will be supported by practically all components of domestic demand. Net exports will have a positive effect on economic growth besides 2015, when high imports are generated by, first of all, continuing growth in exports, but also with high domestic demand. And this high import intensity will dominate the export growth. So that will be the reason behind this slight negative contribution of net exports. In terms of the structure of the national accounts, the household consumption will be growing at approximately 2% on the whole forecast horizon, will reflecting the dynamics of real disposable income of households. You can see a slight slowdown at the end of this year, but this is partially given by the revisions what the Czech Statistical Office did when they just changed the methodology of collecting the data. Investment recovery will be supported by continuing investment activity, both in the private sector, and also increased public investment will contribute during 2014 and 15. And exports and imports will, in a sense, copy the temporary slowdown in foreign demand, what I was showing on a graph describing the external assumptions. In terms of the labor market, the employment growth expressed in full-time job equivalent turned positive in the first quarter of 2014, and the further acceleration in the rest of the year will be primarily a result of increases in hours of work per employee amid continued gradual growth in the number of employees. At the same time, I have to say that we received a new number of growth of employees for the third quarter, and actually that was higher than what we expected. It reached 1%, so I think that we haven't got the hours of work per employee yet, but we'll see how much we'll have to revise this forecast after we will update the data. In terms of nominal wage growth in the business sector, the observed data have until recently been significantly affected by tax optimization from late 2012. Now, newly we were able to do the adjustment based on detailed microdata what we received from the Ministry of Labor and Social Affairs. And based on this adjustment, you can see that the adjusted data now are copying quite nicely the economic cycle. You can see that the adjusted wage growth is gradually picking up from the second half of 2013, and then we assume that this will continue on the forecast horizon as economic activity and inflation will accelerate. In terms of the unemployment rate, you can see that the forecast expects that the seasonally adjusted level of general unemployment rate will stay close to 6.3% until the beginning of 2015, when a slight increase in the labor force and employment will compensate each other. Consequently, the growth of employment supported by economic growth will dominate. And actually, that was a story what we believed in before we did not receive the new data. And actually, this is captured by the blue dot. And this is actually the actual value for the third quarter of 2014. So practically, this is a quite big surprise in terms of what we expected. We expected to get there, somewhere there at the beginning of 2016. So we'll have to analyze what's going on there. And again, this forecast will have to be updated as well. In terms of the interest rate path that is consistent with the forecast, forecast expects the market interest rates will be flat at their current level until the first quarter of 2016, reflecting the two-week repo rate being at the technical zero level over the same time frame, and the assumption of unchanged money market premium. The short-term market rates are forecasted to increase by about 0.8 percentage point in 2016 and the second quarter, and then we assume it will rise further. Okay, let me just shortly compare our new forecast with that what we presented in August. And first, I would just provide you with a short summary. The outlook for headline as well as monetary policy relevant inflation shifted significantly downward until the beginning of 2016. And this is practically almost the whole thing is given by net inflation. For that time period, we haven't got any big revision for administrative price inflation. GDP growth has been revised downwards for both 2014 and 15. And the main reason behind it is weaker foreign demand, and also there is some slight effect of data revisions there. The GDP forecast for 2016 is practically unchanged. The average nominal wage growth in the business sector is forecasted to be lower, starting from the beginning of 2015. The forecast for domestic market interest rates has shifted lower in the late 2015 and early 2016. This is because the new forecast expects the exchange rate to be used as monetary policy instrument until the first quarter of 2016, whereas the previous forecast assumed it would be used only until the third quarter of 2015. Okay, let me start the comparison of previous inflation forecast you can see that the downward revision of the inflation forecast for the rest of 2014 and 15 is quite significant. It's mainly driven by falling foreign PPI, but also lower wage growth in the business sector. Slightly higher growth of administrative prices and food prices are responsible for the higher inflation in 2016. And similar shift what you can see here for CPI inflation, you will see for monetary policy relevant inflation as well. The net inflation reached 1% in the third quarter of 2014, and you can see that there is a downward revision of the forecast for both 2014 and 15. And since the second half of 2016, we have got a slightly higher outlook. Administrative prices, there are absolutely negligible small differences for 2014 and 15, and there is an upward revision for 2016, and the main reason behind this higher gas prices, which are practically a reflection of higher commodity prices and its component in the gas price for households. The forecast of core inflation is revised downward due to, and practically this is the same story what I was showing to you in the marginal costs in the consumer sector. So they are revised downwards, and the main factors are foreign PPI in the Eurozone and lower wage growth in the business sector. The difference between the forecast of food prices is mainly given by lower agricultural commodity prices for most of 2015, and practically this is driven by very good harvest results, what was reported. The GDP forecast has been revised downwards for both 2014 and 15, and again, this is a result of weaker foreign demand, and as I mentioned, there is no significant change for 2016. The one-off effects related to cigarettes front-loading by producers and retailers ahead of excise duty increases are no longer visible in the GDP growth rates, and actually this is another implication of the data revision and new methodology what the Czech Statistical Office introduced. Okay, in terms of structure of national accounts, the households consumption is revised downward mainly for the rest of 2014. I mentioned previously that this is mainly driven by the data revisions. Imports and exports for the second half of 2014 and the first half of 2015 are revised in the same direction, but mainly this is just a reflection of the foreign demand. And you can see here from the graph that we have got a smoother trajectory of for fixed capital formation. The nominal wage growth in the business sector has been revised also slightly downward, and practically this is a reflection of lowering the forecast of economic growth as well as inflation. The forecast for domestic interest rates has shifted lower in late 2015 and early 2016. This because the new forecast expects the exchange rate to be used as monetary policy instrument until the first quarter of 2016. Previously, as you know, it was the third quarter of 2015. The need for longer-lasting easy monetary conditions is mainly due to a lower outlook of foreign producer prices and foreign interest rates. Okay, as I promised you, this is exactly 1 year ago when the Czech National Bank started to use the exchange rate as instrument. And just to remind you, in November 2013, in line with the previous communication of the bank, we started to use the exchange rate of the koruna as an additional instrument for easing monetary policy. The Czech National Bank announced a one-sided exchange rate commitment at 27 Czech crowns to the euro and expressed its readiness to prevent excessive appreciation of the koruna below this level. Following the announcement of the exchange rate commitment, the koruna quickly depreciated beyond 27 Czech crowns to the euro and soon stabilized around 27.5 Czech crowns to the euro without any interventions of the Czech National Bank. The exchange rate commitment quickly established a strong degree of credibility, and we just believe that after 1 year we can draw some preliminary assessment how the economy evolved since November 2013. One of the simplest things is just to compare the hard data. So this table is just generating the comparison for key economic indicators. And practically what is very visible, the economy is growing noticeably, definitely much more than we expected in November last year. And we believe that there is a combination of factors that contributed to this. Of course, this is the recovery in the euro area, relaxed monetary conditions, both in terms of the exchange rate and interest rate, and also increasing public investment. From the table, it's also clear that the good economic performance just have a favorable effect on the labor market, and not only on the labor market, but also on households and business confidence. The only maybe disappointment is that headline inflation fallen slightly compared to the last year and deviated from the 2% target. But actually, if we have a look or we take a closer look on inflation that is adjusted for the effect of tax changes, still you can see that we were able to move from 0.2% somewhere to 0.6%. And we were trying to understand what are the main reasons or main factors that are explaining the undershooting in terms of the inflation forecast. And if you take a closer look on the left-hand side graph, this is just capturing how we gradually revised our forecast. The blue line is capturing our forecast from November 2013. This is actually a forecast that was already generating based on the assumption of using the exchange rate as instrument. And you can see that as time goes on, we gradually just were cutting back the inflation forecast. And one of the reasons why, or actually we try to analyze what are the underlying reasons behind this. And on the right-hand side, we were just drawing the gradual revision of the year-on-year growth of producer prices in the Eurozone. And you can see that there was a very significant revision in this direction. We believe that this is one of the effects that very strongly influenced the Czech inflation rate. Another important factor is that the fall in domestic administrative prices were also deeper than we anticipated in last November. When we were showing these numbers, we were trying to see whether whether we are able to deliver some analytic support and maybe quantify some of these effects. So actually what we did, first of all, we compared the development of foreign variables, and there are practically 3 of them which are key for this analysis: foreign interest rates, foreign prices, and foreign demand. And actually we try to quantify how much was the surprise compared with the outlook what we had in November last year. And actually we were trying to analyze how in our core forecasting model this effect would show up in terms of endogenous reaction of both interest rates, exchange rate, and inflation. And you can see here the blue line is capturing the effect of the surprise in terms of foreign variables on the Czech economy, but in with the optics of our forecasting model. And you can see that the very deep fall of producer prices and the fall of GDP compared what we were expecting in last November is having a quite strong anti-inflationary effect on the Czech economy. The domestic interest rates are trying to stabilize the economy, so there is a cut in interest rates, and also the exchange rate based on the uncovered interest rate parity is depreciating. But you can still, that despite the fact that the monetary policy is trying to stabilize the inflation, still the foreign prices are having a dominating effect and inflation is falling. And also, given that foreign demand is much lower than we anticipated, also it has got a quite strong effect on GDP. Now, we were saying, okay, that would be the case if monetary policy, we would be in a standard regime. So we were asking what would happen if we would impose a zero lower bound restriction, and also we would assume that the exchange rate will not have the stabilizing effect. And this is the other simulation which is showing that if we would impose the zero lower bound restriction and the exchange rate would not play the stabilizing role, then the foreign price development would have, this is a partial effect, would be much more anti-inflationary than if there is this stabilizing role for monetary policy. So practically the brown line is capturing more or less our situation now when the interest rates are not able to react to the negative shock, and also the exchange rate was relatively stable. Okay, so one can say that this is just a model simulation, so I decided to finish my presentation with hard data, and here I'm just capturing the annual inflation rate in September 2014 based on the harmonized price index for most European countries. And you can see that the current inflation rate in the Czech Republic is similar to that in Germany and other European countries with relatively good economic performance. And I believe that without the use of exchange rate of the koruna as instrument by the Czech National Bank, probably we would be in the group of countries with negative inflation rate. So my personal guess, we would be somewhere between Greece and Hungary. So, ladies and gentlemen, that was my presentation. Thank you very much for your attention, and I'm giving back the floor to Mr. Governor.
Well, thanks. Well, first, let me welcome all of you here once again. And, well, the duties stemming mostly from integrating Europe forced me to be the only member of the board here, so apologies for this, but that's our world we are living in now. Well, I hope some of you who are newer to these meetings can find some consolation in the fact that this is a room in which actually the first part of the monetary policy meeting is happening. So actually it served yesterday, and this room serves for discussion with staff about the forecast before the board goes to its own boardroom to discuss among board members and reach the decision. So this is so the monetary policy is really happening here. And while I will open, of course, as usual, the Q&A section, and I will ask all of you to introduce yourself and the institution you are affiliated with. And as usually around Christmas, we will hopefully end around 12, and then you will be led to informal lunch in our club room, and we will have a chance to discuss informally. So that's the plan for now. And now I would like to open the floor for your questions and our experts' answers on anything that's really serious. All right. So please.
Michał de Boer, BNP Paribas. Thank you very much, Mr. Governor, gentlemen. I would start maybe with one observation and...
well, may I ask for... we know each other, but may I ask you for introduction? I might have missed it.
BNP Paribas, Michał de Boer, I'm the economist for the region. So let me start with an observation and a hypothesis first, and then I come to my question, which is probably what is necessary. Page 15, slide number 30. I mean, if I'm looking at the model's implied path for the 3 months pre-bill rate in 2016, I really start to be worried about 2017. And the Czech Republic, you have 150 basis points implied monetary, okay, nominal, but still monetary tightening, which would lead me to the hypothesis you were mentioning once the Corona cap regime would be abandoned, the exchange rate would not appreciate back to the previous level of, let's say, 25.50 that we have seen, say, in October or September of last year. I think in such a brutal rise in nominal interest rates, particularly compared to what is being priced into the euro curve, the exchange rate would have to appreciate in a much more vibrant fashion, and I would not be even thinking that 25.50 would be strong enough. We could be moving significantly faster and significantly stronger for the Corona. But let me come to the question. This is something that I think is very important in order to understand the inflation dynamics as we get into next year in 2016. To me, it seems that a good part of the inflation forecast is based on the expectations for wages picking up, which I think is a sensible way of looking at things. And I would like to ask you, to which extent does the pace of wage growth acceleration in the business sector is because of the improvement in the labor market, let's say growing tightness of that manifested by vacancies, and to which extent this is hinging upon the expected increase in public sector wages next year? Thank you.
Right, so who wants to?
This assumption is really, it has nothing to do with the public sector wages. We really assume that the growing economy and also inflationary pressures gradually moving up will cause practically wages to go up. And also productivity is practically now is even higher than what we can see in wage growth. So we believe that this gradually will feed into wages, and the public sector wages are just a different story.
All right, well, shall I? Please.
Gautam Kalani, Deutsche Bank. Just wanted to know what your thoughts are on the impact of the recent fall in oil prices on the economy, and if we see oil prices around these levels or any further declines going forward, what kind of impact would that have on your view and your forecast?
Well, it sounds to me more like a question for the board. If you read the yesterday's statement carefully, you realize we have a sentence there stating that we consider this to be a positive supply side development. Finally, we got one positive supply side development. That's not so bad. So that's about it. We will, if it's going to get pronounced, we will have to discuss it within such context.
My name is Tomáš Holinka. I am working for Moody's Analytics. I have a follow-up question to my colleague from BNP Paribas, because also I share the concerns about the GDP forecast for 2017 due to increased interest rates and appreciated corona. So the question is, do you have any estimates of the drag from the tightened monetary conditions on the GDP forecast in 2017? Thank you.
Before I ask my colleagues to answer, keep in mind this is not a promise. This is staff forecast. So it's essentially model forecast. It has nothing to do with well. It is probably the best picture of the world in the mind of the model, but quite frankly, I would say the board takes the longer end of the forecast in a rather relaxed way, as I believe we all highlighted here many times before, yeah, because we need to do next step right. We do not have to care about what happens in 2017. If we see that the tightening as such is too high, or that the exchange rate reacts in a different way, then the model assumes, well, there is quite an ample space to adjust to this. Yeah. So that's. But let me.
Actually, I'm envying you that you are worried about 2017 because, to be honest, I'm not sure about 2016. I mean, the assumptions are really becoming, also in terms of foreign demand assumptions, very, very weak. So I would say, no, we were not thinking very heavily about 2017. We were trying to do the best on the horizon we were showing.
But the story behind the interest rate trajectory in the model forecast is the simple. As the inflation is approaching the target, the nominal interest rate must be normalizing towards the medium-term policy neutral rate, which is approximately 3%.
So maybe to put it in my nutshell, you are at the long end of the GSE model. On the long end of the GSE model, everything goes to long-term assumed equilibrium values, simply because the model wouldn't be computational otherwise. So to discuss long end of the GSE model is has very low marginal revenue to your wisdom, I'm afraid.
Dana Hajková, Česká spořitelna. I would have two questions. The first one would be about... Would you more speak to my... Yeah, sorry. Yeah. The revision of the nominal wage growth in 2015, what were the main factors and what contributed to that revision? And the second question is about the slide 35, the scenarios of the exchange rate commitment. What does the graph with the exchange rate actually says? There is this accumulated need of depreciation of 1.2 crowns. Maybe if you could a little bit elaborate on that. Thank you.
Please. In terms of revision of the nominal wage growth for 2015, first of all, we assumed in the initial condition the slightly lower wage growth, and actually that was based on the available data, so that was practically the nowcast. And then on the longer time horizon, this is just a lower economic growth and also lower inflation than we had previously. So these are the main factors. And in terms of your question, in terms of the exchange rate reacting to the foreign development, this is practically saying that part of the exchange rate weakening, given the new information in the foreign environment, is fundamentally given, because that is consistent practically the exchange rate weakening is consistent with the new outlook in a sense. So we interpreted this that this is just a support for a fundamental explanation of the exchange rate, what we can see now.
Are you happy with the answer?
Maybe if you could just explain a little bit the factors.
Which are behind
yes.
Okay.
Thank you.
The main factor is that there are three, as I mentioned, there are three variables that are explaining the difference. So the foreign prices are lower, and actually that means that import prices in the Czech Republic are lower. Then foreign interest rates are lower, ceteris paribus, it's acting the exchange rate in an appreciating level, but foreign demand is lower. And actually the three factors together are causing that inflation is lower because, first of all, you are importing lower inflation, foreign demand is lower, therefore it has got a negative effect on wages, and actually monetary policy is reacting by cutting interest rates and trying to stabilize the economy. And I was just showing that if this would not happen, then practically the price effect, the negative price effect from abroad would be even more significant.
Right, well, next question.
Pavel Stubíček, Unicredit Bank. I would like to ask if the central bank is going to have a traditional debate with the labor unions about the wage growth this year.
Certainly. I think we have the date already set up, if of course. But I do not recollect it, but we have all annual regular meetings, so we will have entrepreneur associations and labor unions as every year.
Jakub Seidler, ING Bank. I just wanted to ask whether you assessed the exchange rate pass-through effectiveness at a zero-hour bound after 1 year, whether it was so effective as you thought, or something changed with this respect. Thank you.
Well, maybe I can give you the policymakers' perspective. I believe the board thinks the pass-through is here. The problem is that there is a deflation in producer prices in Europe in the order of 3%, of 2%, which actually pushes PPI about, I believe it's been in a slide, but quite a significant bit in terms of several percents lower than we assumed, or the consensus forecast actually signaled, because we do not have any too big of independence assumption. That the consensus forecast expected last fall, and I believe that that for quite a few of policymakers, this essentially means that the risks we associated with last forecast have come through, which is a problem.
Yeah, I just maybe thought whether the effectiveness of the exchange rate pass-through is higher at the current situation of the zero-hour bound, because actually it's thought that the effectiveness is higher. So whether this assumption, as was at the beginning, is true after 1 year assessment.
Yeah, the pass-through is pretty in line what we expected the year before when we started to use this instrument. The direct exchange rate channel has just culminated, and we will see slowly evaporating this effect as the nominal exchange rate is stable and the foreign producer prices are still declining. On the other hand, the domestic economy, which previous anti-inflationary effects evaporated very quickly, maybe a little bit more quickly than we anticipated, is now pushing towards the increase of the general price level, and it will be the case so in the future in a progressive way. So there will be this domestic part of the inflation story standing behind the gradual increase of inflation towards the target.
Next question, please.
Jan Čermák, Československá obchodní banka. I have two questions. First one, you mentioned that your model, or you have already mentioned that the core assumption of your model is that the equilibrium interest rate is 3%. So my simple question, the first one is, how many board members believe in this core assumption? And the second question is, we checked your survey on inflation expectations, and unfortunately, the Czech Republic or Czech economy has not the advantage to check market expectations, inflation expectations derived from financial markets. So we checked your survey among non-financial corporations about inflation expectations, and we have found out that they are falling, so still falling. So my question is whether you care about it. Thank you.
Start with, well, on the first question, I'm afraid the answer is simple. I have no clue. I don't think that the board cares about that much. The board, I believe, views the model as something that provides rather useful hints for next decision. I honestly don't think that we discuss more how much the forecasts of general, of consensus and of us and others are influenced by the fact that the current generation of the models is simply closed by getting back to equilibrium values. Meaning we are aware of the fact that 2017 is essentially set up in the model no matter what. Meaning also we frankly do not care that much how the end is tight as soon as the model works nicely for next decision. Yeah. That's completely different way of viewing the model, and I'm repeating once again, we have great advantage of not having to forecast what the values of variables of interest are going to be in 2 years' time. We are not providing help to bettors on this. We are simply trying to do the next thing right. So I don't think that even some board members would have the answers ready to your question in their mind. Point is that it's relatively pointless thinking for me, for example, to put a personal perspective in this. As to expectations, frankly, now it sounds to me again the question for policymakers. Some of us are taking more care with expectations, some of us less. If you ask me, I'm more for expectations of financial markets, in which I see some expertise and ex-ante thinking. The rest of expectations, as history, I believe, teaches us, are more or less based on adaptive, essentially, perception of reality. So I'm not making too much about them. I'm much more interested in sort of real leading indicators. In our case, for example, how the housing market develops, because this tells you probably more about what people think about the future inflation. But this is my own way of thinking about the reality. And I believe the major reason why I'm doing this, I believe the expectations didn't forecast at all the Japan deflationary situation. They were so you see, so as a leading indicator, their value is relatively low in my opinion, especially in situations like this.
Morning, Mai from Bank of America Merrill Lynch. I have 2 questions. The first one, in your external assumption in the inflation report, you have Eurozone growth around 1% and 1.6% next year. What if we're in a situation when Eurozone is stuck between 1.5 and 1% and inflation cannot pick up? I know that domestic story is picking up, but how much will that offset the external situation, although in the global, also in the global picture of weaker growth? How would that affect your thinking? And second question is, we are certainly in a time that Europe in general is going to a lot of monetary easing. Would you see central banks in the region, like Polish central bank, the Hungarian, going, the Czech style of putting in some exchange rate intervention? Would that be an influence on the board, or how may that impact your thinking?
Well, sounds to me like policymakers' questions. So first, as to Eurozone growth, well, we already saw essentially the pass-through of lowering of Europe growth on our forecast. Like we are down. For me, pretty insignificant amount of 0.4, I believe, or 0.5% for the next 2 years. Which, in my experience, is fairly below the variance of GDP forecast of GDP measurement, maybe even not forecasting. So I'm not making too much out of this. Saying this, the problem with consensus we are using is that, in my opinion, it's not that significant in situations like this. It's just an average of forecast. It's not even the consistent modeling. And I believe for us the major role is going to be played by the fact that euro is weaker by 7%, which is going to contribute to our major trading partners, which are same industrial-oriented economies or export-oriented economies as us. Yeah. I'm not saying it's going to help too much the economies which are to be helped by easing, but that's really, frankly, not my concern. Yeah. And so 7% is, to put it in a nutshell, 7% is quite a good news for German exporters. Yeah. And that's going to influence us, yeah, because we care about effective demand in Eurozone for our products. We do not that much care about the Eurozone situation as such. So this is one of the things that is changing the picture. Second, however, on the other hand, the risk is that the consensus has just adjusted only the close end of GDP curve, and has not really adjusted 2016. If you would have a look on comparison of consensus forecasts in time, you would find out that now we've seen something like big drop in 2015 expectations, but 2016 stays essentially where it was before, which I find relatively optimistic. That's or myopic. That's the second thing. That's on the downside. On the upside, oil is there. That's simply quite clear first positive supply shock for Europe. Yeah, that's a good news. So all these things I'm more or less observing, and I will try to. We will see what's going to happen around this. But as I said, as we've been slowed down by more than the Europe slowdown, because the German economy is obviously not in such a perfect shape it was assumed to be. On the other hand, also the fact that the currency is weakening is going to offset this in future from our perspective, from perspective of our economy. As to our colleagues, well, I believe that's not too polite to talk about colleagues. Just the world has changed amazingly to me. I would never expect to see one-digit inflation starting with 1 or 0 in some countries, or with a dash in others. And saying this, they still have a population or consumers who are not that used to the world of low prices and very low inflation, which gives them more space actually not to do anything unstandard, because the expectations are still there that the prices are going to rise. So they can, to put it in a different way, they can more afford brief flirting with 0 or negative values than us. Yeah, that's. And that may give them some space. On the other hand, they are going down quite fast. Yeah, it's certainly the So scenario has some plausibility now. From our perspective, still, it wouldn't be a big deal. They are not our major trading partners anyway. More questions, please? Please.
Jaromír Šindel, Citibank. I would like to ask you about how you are convenient, let's say, about with the possibility, if it's necessary, to hike the Euro-Czech floor in times, for example, when we see currently in Bank of Japan. For example, if you look now at Bank of Japan, which is, let's say, trying to ease its currency. If you look at ECB, which is also trying to weaken its currency. If you look at other countries in the region. So we are a little bit more closer to something like currency wars. So I would like to ask you about this. If you, for example, if you see another drop in GDP in Western Europe, if you are really so easy to hike the Euro-Czech floor without any, let's say, consequences on the international politics.
Well, we are certainly very comfortable with the current exchange rate developments. Yeah, that's for sure. And broke, don't fix it. Yeah, that's my answer. It seemed to me that you and your traders understand pretty well that the exchange rate is now not an exogenous variable, but a tool. And in my opinion, as soon as the tool works so nicely, why to meddle with it? That's really pragmatic. In terms of plus ECB, ECB is essentially doing something from our perspective. Yeah. I'm not sure how much of QE gets in south of Europe, but honestly, we are not trading that much with Portuguese as we do with Germans. Yeah. And so in this respect, you see, Eurozone is not homogeneous space that provides homogeneous impulses to our economy. As soon as they revive the economy, the export part of economy in Germany, this is going to bring us some positive impulses as well. Yeah. That's and it seems to me to be actually more realistic to expect this than any fast impact from easing in the real problematic parts of the Europe. But as I'm saying, that's really not my business to. So as soon as it works for us, I'm fine, and it works for us. That's
if I may, I think. Well, at least here, because if there are no ones, then let me conclude. But I wanted to ask you one specific question, because we all know, I mean, the world is pretty much uncertain. There are so many risk factors right now down various continents, various economies, also here in the vicinity of Central Europe and the Czech Republic. But is there any particular risk that you would see in the Czech economy that could substantially affect your projections or your forecast or your thinking about growth and about inflation, but something really focused on here?
Well, the answer is no. I mean, like the Czech world is working pretty much as we expected it to do. It seemed to us. Let me just. And it seemed to me also that we can do a lot with fiscal and monetary policies, as we've seen, by the way, in consolidation phase as well, in fiscal consolidation phase. We are influenced by macro policy, and we are influenceable by macro policy. And as soon as we do not really reach some ceiling of our production possibilities, which we would then see in worsening current account and foreign trade worsening in a grand way, and inflationary pressures. And frankly, I'm not expecting to see this anytime soon. We simply have a space to react, so I'm not that worried. And I believe the most risks external and the most significant external risks are simply coming from Eurozone. It's in terms of insufficient easing of monetary policy. But on the saying this, I also must say that it seemed to me that ECB is now doing probably more than most of us has expected last year around this time, after, of course, the period which was a lot of worse than we expected around this time last year. Yeah. So there is a reaction. Yeah. That's a good news.
Any more questions? Well, okay, so you are such a very disciplined crowd. Thanks a lot. Now let's move for a lunch. Yeah.